Today we have Anthony Desano from Embrace Home Loans. He's going to tell us about the recent Fed hike increase. So come on, Anthony, introduce
Yes.
yourself.
Hi, my name is Anthony. I'm a loan officer at Embrace Home Loans in Newport, Rhode Island, Middletown, Newport line. I've been doing it for about, 18 years now. I'm 51. So have a little experience in this. Learned along the way, of course, everything that knowledge I do have. So in regards to the Fed, the Fed raises the prime rate or lowers the prime rate during the course of the years when they decide, whether it needs to be raised or needs to be lowered. The one thing to know is that it does not have a direct effect on mortgage rates. It has an indirect effect, and I'll explain why. So if the Fed raises the rate a quarter of a point, that doesn't mean your mortgage rate that you got quoted 2 weeks ago is now a quarter of a point higher. It doesn't mean that. It just means that the Fed is trying to do something for the economy, whether it's to help boost the economy. Well, it's always to boost the economy, but it's a matter of where the economy is headed. Right now, they're worried about a recession. So the way to stop a recession is to get rates higher. So that's a positive thing that the government is trying to do for the economy. So that's why they're doing it. Even though borrowers probably don't care for a higher interest rate when they're going to buy a home,
Correct.
but
They
that's the
panic.
reason why the Fed is doing it. So if it
Right.
doesn't have a
Why do
direct,
people panic though? Why do you think people panic as soon as they hear the increase?
they don't want their $1,500 payment to be a $1,600 payment. So
Exactly.
it's as simple as that. But so if the Fed doesn't have a direct effect on mortgage rates, then and how do mortgage rates work? And that's kind of what I'm going to explain to you. Mortgage rates work off of the 10-year bond market. So if you're studying or watching the 10-year bond market, there's a yield. You can go on wallstreetjournal.com, and there's a lot of different places you can see the 10-year bond yield, and it'll go up and down, and it goes up and down every day. So that's where mortgage rates originate from every single day. Around noontime is when you see that day's mortgage rates will change one way or the other. And it's based on that day's trading, investor trading. So the Fed doesn't have anything to do with raising mortgage rates or lowering mortgage rates at all. It's that 10-year bond. So what happens when the Fed raises interest rates with the prime rate, and how does that affect the bond market? Well, if picture investors, whether they're company investors, personal investors, they have to put their money somewhere. They want to invest their money somewhere. When the economy is good, when things look like, hey, American companies look like they're going to be prosperous over the next couple of months, they'll take their money and they'll put it in the stock market. You'll see the stock market shoot up. If they're putting their money in the stock market, they're not putting their money in the bond market. So if they're not putting the money in the bond market, the bond yield goes up, interest rates for mortgages go up. So basically, people investing in stocks, not investing in bonds, mortgage rates will go up. The reverse is true. When the economy looks like it's tanking, you don't want to invest in companies. It doesn't look like the economy is doing too well. People take their money out of the stock market and put it into the bond market. Bonds are a safer investment. So they're not going to risk their money in the stock market. They're going to put their money in the bond market. Now, when the bond market gets infiltrated with a bunch of investing, the yield comes down, mortgage rates come down. So basically, the bond market does this, and that's the yield. So if you're investing in the stocks, you're not investing in bonds. Mortgage rates up. If you're investing in bonds and not in stocks, mortgage rates will come down. So that's what happened. So what happened here was the Fed decided, hey, we're going to raise interest rates. The purpose of that is to try to stimulate the economy or keep the economy from going into a recession. That's a positive thing. So what happened was people who invest their money, companies and just regular people like me and you, decided that's a positive thing for the economy, and they'll push their money towards the stock market. If they're investing in the stock market, they're not investing in bonds. So the mortgage interest rates will go up. So it's an indirect relationship, but it doesn't always work that way. If for some reason investors just thought that even though they're raising the interest rate, I'm still not confident that the economy is really looking all that good. So they might still invest in bonds rather than the stock market. So you're really at the mortgage industry is at the whim of where people are investing their money. And so that's how,
Exactly.
what the Fed says and what the Fed does causes people to invest in one place or another, and it causes mortgage rates to go up or down. So that's the indirect relationship. Now, there is one other scenario, which you probably may have heard of, rates being artificially low in right around that 2019, 2020 era. Here's what
Right.
happened there, because this is an instance, because what I'm trying to say is stock market up, bond market down, bond market up, stock market down. Very rarely do you see both. And in this instance, in 2019, the economy was doing great. We were booming. Our 401ks were making a ton of money. Everybody was prospering. And yet mortgage rates were really, really low. So how can that be? If the economy's great and everybody's in the stock market's booming and everyone's investing in the stock market, well, why in the heck were mortgage rates low? And this is how. The Fed wanted to give a boost to the housing market. They felt as though the housing market had maybe slowed, and they wanted to give a boost to the housing market. So what did they do? They invested tax dollar money into the bond market. So they flooded our tax dollars into the bond market. So the stock market was doing great. The bond market was also doing great, which is not supposed to happen.
Right.
So they basically, what happened was, even though investors weren't putting the money into the bond market, they were putting it into the stock market. Our US government was putting money into the bond market. And so they were making the bond market a better place, keeping interest rates low. So you had both things happening at the same time, which is not good. And it's what, I mean, I'm not an economist, but you can't have both low interest rates and a booming economy. It just doesn't work that way. When the economy is booming, interest rates are higher. When the economy is in trouble, interest rates are lower. That's just the way it's supposed to be. You're not supposed to have both things happening at the same time. And that's part of what causes inflation.
So
So
what is the likelihood of us ever seeing those interest rates again? You know, everybody wants to know.
when's the next pandemic? Because
We don't know.
that's probably right. Right. So see what I mean by that is it's so unpredictable. You don't know what's going to happen from one day to the next. Who knew
Exactly.
a pandemic would cause interest rates to flop? And that was the other thing. You know, interest rates were already low in 2019, and when
Yep.
2020 hit and the pandemic hit, now you have a horrendous economy, and everyone took their money out of the stock market. Naturally, you're closing businesses down. And of course, everyone's taking their money out of the stock market and putting it into the bond market. And the federal government had already put money into the bond market. So now you have not only the federal government putting money into the bond market, but also regular investors, because they're like, well, if businesses are shutting down, I'm not putting my money in the stock market. I'm
Right.
putting it in the bond market. So now you had both things happening at the same time. And that's how you end up with a 1.99 interest rate, which is ridiculous. And that's what we had in 2021, the end of 2020, which was crazy, because it was just an influx of all kinds of money into the bond market because the economy was so, crashed right around March or April, when everybody started shutting down their business, or the businesses were shut down. So who could have predicted that?
Nobody.
Do we end up in a war with Russia? I hope not, but if we do, that's going to be a problem. So anything that causes uncertainty uh, keeps people from investing into the stock market and puts it into something a little bit more secure, like the bond market. So we end up in a war, we end up with a pandemic, we end up in a recession, which still could happen. They're raising interest rates to keep us from having to use the word recession. It still could happen. If we end up in a recession, rates will come down. If we end up with another pandemic, rates will come down. We go to war with somebody, rates will come down. Anything that causes any kind of instability in the economy will cause rates to go down. So, because again, people influx of money into the bond market when they feel unsure about where the country's going or where the economy's going.
Right.
So.
That's true. So for those buyers, now it's about to be the busy time. We're coming up on
Oh
March,
yeah.
April,
Oh,
May. It's about to flood. So some
yeah.
people are still on the fence and they're nervous and scared. What would you tell them is the best time to purchase?
First of all, I would make sure you have a payment in mind that you can handle, and really don't try and max yourself out with that. Like, don't push yourself to the brink where, hey, here's what it's going to come in, and then try not to live paycheck to paycheck. That's what's really important, because that's stressful to try and live that way. So find out where's that comfortable payment for you, and once you figure that out, then you go from there. Okay, well, what does that mean for me? Where's the interest rate, and what does that mean for me as far as what size purchase I can I do? 200,000, 300,000, 150,000? Can I do 500,000? And so figuring that out is step one. Once you know you're in a comfortable area where, hey, if the rate's 5.5% or 6.5%, I'm still in that comfortable area of payment, then get on it.
Regardless
Yeah, get
of
on
the
it.
rate. Right.
Yeah, I wouldn't worry about the rate because you're going to be able to refinance that rate.
Exactly.
At some point,
Exactly.
there's going to be a refinance boom again because with rates in the 6% range, and once they go back to the 4% range, and they naturally will. In my 18 years, I've seen it do this for all kinds of reasons. So it will come down to the fours again somewhere, whether it's 1 year, 2 year, 3 years, or 5 years from now. And those people buying now are all going to refinance into better rates at some point. So I wouldn't worry about that. But again, keeping in mind what is a payment that won't cripple you, and stick with that parameter at the highest rate possible. So what I mean is, if interest rates are anywhere between, the best interest rates are at 5.5 and the worst interest rates are at like 6.6 or something, well, figure out what your payment would be at 6.6 and say, hey, well, if I can buy a $200,000 home at a 6.6 interest rate and I can make that payment work for me, go with that, and then hopefully it ends up being a little bit better. Maybe you get
Exactly.
5.99%, and it's even better. But
Exactly. Because if it goes up, you missed your window. You were waiting
yeah,
for this window of opportunity when you could have created your own window of opportunity by
yeah,
buying now
yeah, yeah. I mean,
based
I
on
would
what
I
you
would
can
jump
afford.
on it. Yeah,
Right. So thank you so much for all of that. You say you're not an economist, Anthony, but you
I'm
gave us
not. I'm
a
not.
big breakdown. You gave us a good breakdown right there.
Yeah,
So
yeah,
lastly, what do
yeah.
people need to bring to you before they come to me or while they're coming to
Mm-hmm.
me? And I
Mm-hmm.
say, well, hey, talk to Anthony. What do they need to have, whether they are self-employed, W-2, what do they need to have?
All right. So the type of loan is going to matter. So let's start with just a regular, average Joe, pay stub type person that's getting paid taxes. They're not self-employed. Taxes are being taken out of their paycheck every day. If you're doing an FHA or a VA loan, you're going to need 2 years of W-2s, not tax returns, W-2s, the little slips you get, at the end of the year so that you can go file your tax return. So 2 years of that. So right now, we're at the point where 2022 W-2s have come out. They're mandatory to have come out by January 31st. So for anybody doing an FHA or VA loan, 2021 and 2020 W-2, 2021 and 2022 W-2s will be necessary. And, FHA wants 2 pay stubs, but you can submit one now, and during the process, as you get another pay stub, you can submit that second one later. I tell all my people to just send me one stub up front because the underwriter always asks for a pay stub towards the end of the process anyway, and
Exactly. Yeah.
that'll make up your 2 pay stubs. Now, conventional loan only need the 2022 W-2s unless your income is such where it needs a 2-year average. Instances like that are people that are people that work part-time. If you have a part-time job, then you're going to need 2 years W-2s, even for conventional, because you need to average out the income from 2021 and 2022 and do an average. But somebody that's working hourly or salary, and you want to do a conventional loan, only the 2022 W-2 is needed. So that's your regular employed people. Now, self-employed,
It gets
FHA
fun
and
with the
VA.
self-employeds, right?
Oh, yes, yes, it does. Well, the interesting thing is with FHA and VA, self-employed people need to have the 2 most recent years tax returns. So,
Right.
at this point, you don't have to have filed 2022. So 2020 and 2021 tax returns will work. But FHA and VA, 2 years of tax returns, not the state. You don't need the
Two
state stuff, just the
years.
Fed. 2 years. Now,
Yes.
go to conforming, and it's a little dicey. If you've been at this self-employment job and working, whether it's self-employed as a 1099 or you actually own the business, if you've been doing that for 5 consecutive years, conventionally you only need 1 tax return, the most current one, which could be 2022 or 2021, depending on which one you filed most recently. If you have been operating this business for less than 5 years, well, then now it's 2 years tax returns for you on this instance as well. Here's one last key note about tax returns when I'm talking about 2 years and 1 year and all of that. We're in 2023. So you can't say at this point that you have not filed your 2021 tax returns. Very important. Mm-hmm. Yes, people can get extensions for tax returns, but those extensions, tax returns are due April 15th of every year. So 2022's tax returns are going to be due April 15th, 2023, sorry. So your 2022 tax returns are due then. If you file an extension, that's fine. You've got until October, which means you don't have to have filed your 2022 tax returns if you want to buy the house in May, June, July, August, September, or the beginning of October. But once October 16th comes, those 2022s have got to be filed. There are no extensions past that. People might
Right.
think that there are, they may be mistold some information. But come October 16th, 2023, those 2022s have to be filed, which is
We
why I'm
ran into
saying,
that, didn't we? We ran into
yes, we
that.
did. I still have some people now that said, Anthony, I haven't filed my 2021s. And if you haven't filed 2021, there's no loan for you right now. There's no,
Correct.
you've got to get that filed. So that's why I'm saying 2021 is not an option to say I
Right.
have an extension. It just isn't. Now, does the IRS have some crazy circumstances where they'll allow you beyond that October 15th deadline? I don't know, maybe 18 years. I haven't
Yeah.
seen it. I don't know what that would be. I wouldn't plan on that. If October
No.
16th comes, you need that year's tax returns done. So,
All right. Well, you all heard that. So thank you so much, Anthony. You really broke it down for us. And
no
don't be
problem.
afraid of the interest rate. Anthony should have helped you see. Don't be afraid. Only worry about your particular circumstance. And now you know
Yes.
what you need to bring before you even start looking for homes. And then, of course, you'll call me, your favorite realtor, and I'll put you in contact with Anthony, your favorite lender. Thank you so much for watching today, and I will see you all in the next video. Bye.
Bye, guys.